Hello everyone, this is Alexander Nikolov from trendrecognitions.com, and this is the chart of S&P 500. Today I'm going to discuss the short-term outlook before the S&P 500. The main question now is, of course, are we already in a bear market with the decline that we've seen since April stop, or the bull market from last year's low is still intact? Well, as you know, I was looking for a broad sideways consolidation back in April and in early May. After the huge drop in early May, I was looking for some kind of a sideways consolidation that eventually was going to break higher to new highs. But the decline in late June below the 1040 level, this is very important level, 1040, and the fact now that the price is below the 100-day moving average, this is the blue line, and the 100-day moving average itself is trending lower, this is an indication that we are already in a bear market. An argument can still be made, of course, that we are in a bull market, considering the divergence in daily MACD indicator. If you can see here, there is a divergence with the recent low in S&P 500. The market made new low 2 weeks ago, and the MACD indicator didn't make new lows. So there is some positive divergence. So there still can be an argument that we are in a more bullish outlook for the coming months or so. But the whole picture, the entire picture, doesn't look so good right now. Let's go to the chart of the Volatility Index, the VIX. As you can see here, the volatility spiked up in May and then spiked up again in June, but now has declined steadily for the past week or so. And you can see how quickly the fear has gone from the market. The volatility is, the VIX index is back at 25 area. So you see how quickly the fear has gone, which means that the sentiment is still bullish, which is a dangerous sign that the market is actually in a bear market. And one other chart is very important here. This is a chart from stockcharts.com. It shows the percentage of stocks within the S&P 500 index, the percentage of stocks that are above the 200-day moving average. You can see that currently only 49% of stocks within the S&P 500 are above their respective 200-day moving average. This percentage was above 90 back in late April, early May. It declined to even to 27% a week ago. Now it has recovered a bit, but still you see the trend here. The trend's negative. This blue line is the 50-day moving average of this chart, and you can clearly see that the trend is down. So until these percentages improve, that means that the internal strength of the market improves, the internal structure, that means more stocks move above their 200-day moving averages, things don't look good. Only if this percentage moves above 60-65%, then the market will be healthy. Now things don't look good. Let's go back to the chart of S&P 500. So if we are in a bear market, what can we expect? How long this current bounce from last week can continue? Based on the structure of the daily stochastics indicator, if you take a look at the early June's rally, you see how quickly it faded uh, when the stochastics got overbought at that time. So what I expect here is to see another overbought readings from the daily stochastics. Probably this will happen in 3 to 5 days from now, and then I expect the market to roll over and head lower. Once it breaks below 1040 again, I think the next stop will be near 984 level, then 940 area. So the trend here is down. So until the market, as long as it is below the June stop at 1130, I think the trend is lower, and this trend should be respected. So in conclusion, as long as we are below the June stop, 1130, 31, we are in a bear market. That means this bear market should be respected, and that means that the proper strategy to trade is to sell rallies. So after 3 to 5 days from now, when the daily stochastics gets overbought and the market rallies a bit more, a short strategy can be considered against the June stop. If the June stop is exceeded, then, well, we are probably back in a more bullish mode. But for now, the trend is lower, and one should probably sell rallies. Just to finish this presentation, let's go to the hourly chart to see the internal structure of the bounce from the 10, 11 low that was recorded 5-6 days ago. So this rally is very sharp, fast moving. This is a typical of bear market rally. So if the market was to begin a new bull trend, probably we would have seen some basing here, some sideways consolidation, and then the market would have broken higher. But with this sharp rally, this is more an indication of a bear market rally. So I would look to consider short positions in 3 to 5 days from now. Thanks for watching, and I'll be talking to you later this month.